company that grew its market cap 10 times in 12 years under one CEO, controls the cloud infrastructure that runs half of corporate America, and just crossed $50 billion in quarterly cloud revenue, and the stock is down 33% from its highs. That's the setup.
33% off the top for a company growing revenues at 17%. That's either a correction or an opportunity.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're diving into Microsoft, ticker MSFT, the company that went from legacy Windows maker to the AI enterprise powerhouse. Lana Chen is here to break down the numbers.
Let's go.
Microsoft is headquartered in Redmond, Washington, founded in 1975 by Bill Gates and Paul Allen. But the company we're analyzing today has been fundamentally reshaped by one man, Satya Nadella, who took over as CEO in 2014 and pivoted the entire business toward cloud and AI.
The revenue mix tells the story. Microsoft operates through three segments: productivity and business processes. That's Microsoft 365, Office, Teams, and LinkedIn. Intelligent cloud, Azure, server products and enterprise AI services. And more personal computing, Windows, Surface, Xbox, and Game Pass. Azure is the growth engine, up 39% year over year, and total Microsoft Cloud revenue just exceeded $51 billion in a single quarter.
The competitive landscape is formidable. Amazon's AWS still leads in cloud market share. Google Cloud is growing fast. And on the AI side, they're both a partner and competitor with OpenAI. But Microsoft's moat is the ecosystem. 1.6 billion Windows users, over 400 million Microsoft 365 commercial seats. When enterprises adopt Copilot, they're deepening their commitment to the entire Microsoft stack.
And the scale is staggering. Trailing 12-month revenue of $305 billion, that puts Microsoft in an extremely exclusive club.
Satya Nadella has been CEO for 12 years. He joined Microsoft in 1992, worked his way up through various executive roles, and took the top job in February 2014. His educational background is engineering, electrical engineering from Mangalore University, computer science from UW-Milwaukee, and an MBA from University of Chicago.
What Nadella has accomplished is historically remarkable. When he took over, Microsoft's market cap was about $300 billion. Today, it's $2.77 trillion. That's roughly a tenfold increase in 12 years. He killed the stack ranking culture, embraced open source, pivoted to cloud first, and positioned Microsoft at the center of the AI revolution through the OpenAI partnership.
The growth mindset CEO of the growth mindset company.
The stock is trading at $373.46, with a market cap of $2.77 trillion. The 52-week range tells an interesting story. 344 to 555. We're in the lower third of that range. The stock is down 33% from its all-time high.
That's a significant drawdown for a mega cap of this quality.
Which is why the valuation looks attractive relative to history. The trailing PE is 23.4. That's actually below the S&P 500 average. Forward PE is 22.5. Price to sales is 9 times. EV to revenue is similar. For a company growing revenue at 17% with 47% operating margins, these multiples represent genuine value.
Revenue breakdown?
$305 billion trailing. Q2 FY2026 hit $81.3 billion, a beat. Q1 was 77.7. Q4 was 72.2. That's consistent acceleration. Azure grew 39%, and they guided for continued strength.
Profitability?
Gross margin is 68%. Operating margin is 46.7%. EPS of nearly $16 trailing. These are exceptional margins for a company at this revenue scale. The software plus cloud model throws off enormous operating leverage.
Cash flow?
Free cash flow was $71.6 billion, operating cash flow $82 billion, CapEx of about $10 billion, though that's ramping significantly with the $150 billion AI infrastructure investment commitment. Cash on hand is $37 billion against $53 billion in debt, current ratio of 1.42. Overall, Microsoft's financial health is strong. The combination of revenue growth, margins, and cash generation at this scale is virtually unmatched. The stock's pullback has created the most attractive entry point in over 2 years.
Analyst picture?
Near unanimous bullish consensus. 54 analysts covering the stock, 51 rate it buy, 3 hold, 0 sells. The average price target is $589, implying 58% upside from current levels. Range runs from $392 to $730.
58% upside on a $3 trillion company. That's remarkable.
Wedbush estimates Azure and Copilot could add $25 billion in revenue by fiscal 2026. Copilot has been adopted by 90% of Fortune 500 companies. The Windows 10 end of life is driving a 250 million plus enterprise PC refresh cycle. Last earnings beat on both revenue and EPS with strong guidance for continued momentum.
Bull case number 1, Copilot monetization at scale. 15 million Microsoft 365 Copilot seats with 160% year-over-year growth. Enterprise multi-seat purchases are expanding rapidly, and the revenue potential is enormous if penetration moves from 3% toward 10 or 20.
That's the entire bull thesis in one product.
Number 2, Azure capacity expansion. An 80% capacity increase targeting in FY2026, plus massive investments in Canada and India. As AI workloads grow, Azure's demand far exceeds current supply. Number 3, the enterprise PC refresh. 250 million PCs need to replace Windows 10 with AI-enabled machines. That drives both hardware sales and Copilot adoption. Number 4, M365 price increases, averaging 16% taking effect in July 2026.
Bear case. First, Copilot monetization is lagging expectations. Despite 15 million seats, paid penetration is only 3.3%. Enterprise ROI concerns are real, and adoption is slower than the hype suggested. Second, regulatory risk. The FTC is investigating the OpenAI partnership for potential antitrust violations. The UK CMA is probing cloud licensing practices. These could constrain Microsoft's ability to bundle and price aggressively.
Regulatory is the tail risk nobody wants to price in.
Third, AI competition. OpenAI itself dominates with 55% market share versus Copilot's 11%. Google's Gemini is gaining enterprise traction. The AI landscape is fragmenting faster than Microsoft can consolidate. Fourth, the infrastructure capex burden. $150 billion in annual AI and cloud spending creates significant execution risk if revenue growth slows.
How does Microsoft compare to the mega-cap peers?
Against Apple, Microsoft trades at a lower PE, 23 versus 32, with comparable revenue growth. Microsoft has deeper enterprise AI integration. Against Alphabet, similar multiples, but Microsoft has the productivity suite advantage and stronger enterprise cloud positioning. Against Amazon, Microsoft trades at a significant PE discount, 23 versus 52, despite higher margins. AWS leads in cloud market share, but Azure is closing the gap and growing faster.
So Microsoft is actually the cheapest mega cap on a PE basis right now.
It is, and that's unusual for a company with these growth, and margin characteristics.
Options market.
Put-call ratio of 0.92, nearly balanced with a slight bullish lean. IV at the 58th percentile, moderate. Large call open interest at 400 and 420, and put support at 360 and 350. The options market sees the stock as range-bound near-term with upside optionality on AI catalysts.
Insiders?
One notable buy, Director John Stanton purchased nearly $2 million in shares at $397 in February. That's a significant board-level bet. On the sell side, 12 transactions, including a $10 million executive sale, typical portfolio rebalancing. The Stanton buy is the more telling signal.
Key metrics to watch.
3 things. First, Azure growth rate. 39% is strong, but any deceleration below 35 would pressure the multiple. Second, Copilot seat penetration. Watch for the 3% to move toward 5 or 10%. That's the revenue unlock. Third, operating margins. The massive capex should start flowing through. If margins contract below 45%, the efficiency narrative breaks.
Lana, bottom line on Microsoft.
Microsoft is one of the highest quality businesses in the world. $300 billion in revenue, 47% operating margins, $72 billion in free cash flow, and a dominant position in cloud and enterprise software. The stock's 33% decline from its high has created the most attractive risk-reward setup in years. At 23 times earnings, with 58% upside to consensus, this is a rare case where quality and value align. The key variable is Copilot. If enterprise AI adoption accelerates, Microsoft reprices dramatically. If it stalls, the stock stays range-bound but well supported by fundamentals.
We'll close with Satya Nadella himself. Microsoft's mission: to empower every person and every organization on the planet to achieve more.
Simple, ambitious, and so far backed by $2.77 trillion in market value.
That's going to do it for episode 53 of Charged Alpha, Microsoft, ticker MSFT. If you found this breakdown valuable, share it with someone in tech investing. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street